We've got breaking news coming in right now. One of China's largest companies just reported their earnings, and take a look at that. Issued downside guidance. I'm talking about Baidu. It is huge. It's a $69 billion internet search engine like their Google, right now getting hammered down 8% in the aftermarket. Now, this brings us to today's sell-off. It was sparked by one of the biggest one-day sell-offs ever in China's stock market. So, what is China's threat to the global economy? And by the way, what are the parallels/warnings for our economy? Joining me now is Shah Gilani. He's the editor of Capital Wave Forecast. Listen, Shah called the China route before everyone right on this show more than a month ago. And more importantly, he put his money where his mouth is. So far, Shah, you have been 100% right. What's going on with China's market?
I think it's got a lot further to go down because the margin lending has been extraordinary. From just April 10th to the highs, which was June 12th, margin lending increased about 153%. Since the highs, it's fallen about 36%, but that's a drop in the bucket compared to the hundreds of billions of dollars that are out there. So there are going to be margin calls. I think we're going to see more of them tomorrow. I think we can get into that negative feedback loop that we saw back in the U.S. in 2008, where margin selling begets more selling and pressure on prices, and we just get into a tumble, and that's what's going to happen in China. I don't think there's anything to stop it. The government has done everything they can. It's proven to be pretty much ineffective.
So, Shah, you're saying now that the Chinese government has shot all of its bullets, or maybe they just back off and say, let the markets do what the markets might want to do and just give up?
I don't think they're going to do that. I don't think they can afford to do that by any stretch. The IMF would like the government to step back and let markets be free, but it's far too late for that. There's too much invested in terms of the stock market, the investors who are in the stock market. There are manufacturers and producers in China who are using their capital to speculate in stocks. They're all getting hit. So this is an economic event. This is not just a market event. So the government has to do what it can. The markets essentially have become a ward of the state.
Well, so what are the parallels? Because, you know, when China's market went up 160% in 1 year, we never spoke about it. No one said, hey, China's up 160%, rather, we should be up 160%. But as soon as China starts to crash, everyone says there's some sort of warning there and that American investors should heed that. What is it?
Well, the warning, I think, is that central planning doesn't work in terms of free markets. I mean, you can't have both aligned and expect one to, take care of the other. It just doesn't work that way. So I think what the lessons are for American investors is that the central bank, the Federal Reserve here, isn't going to be the be-all, end-all at the end of the day if the market decides it needs to go down, especially if the Fed starts to raise rates. So what this lesson tells us is that markets, if left on their own devices, need to find wherever the actual price level needs to be, and manipulation isn't going to get us there. You know what? I got to tell you something. People always think I'm nuts when I say it, but I like when those same markets find when they have to be faster rather than sooner. I don't want the torture, the water drop torture. Take me there. If it means a one-day crash, take me there.